This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hi. We've got one final point to cover in respect of foreign subsidiaries. We've already talked about the need to retranslate them, that all the assets and liabilities get remeasured at the closing rate, that the profits and losses get remeasured at the average rate, and above all, that exchange differences don't go in the profit and loss, but they go to reserves. And for the sake of our exam, we would probably type they're recognised in other comprehensive income. Now, there's a special rule that you need to be aware of when we come to sell the subsidiary. And you can see it here in the course notes. It's actually, for academics, I suppose, a very exciting concept. All of those gains and losses are accumulated in reserves. When you sell the subsidiary, they're said to be realised because you've actually sold the subsidiary for money, and therefore logic might say that they should now be recognised in the profit and loss. Now that causes a bit of an academic problem because they were earlier recognised in other comprehensive income. So some people say, well, doesn't that mean you're recognising them twice? The sort of solution is that they're reversed out of other comprehensive income and come into the profit and loss account. This process is known as recycling, and there's a lot of debate as to whether recycling is the correct thing to do. It only happens in very rare circumstances. You'll meet others later in the syllabus, but it certainly doesn't happen with things like the sale of PPE. When you sell PPE, you make a reserve transfer, moving gains from revaluation reserve to retained earnings reserve. But this is arguably a bit more exciting because you're moving those gains from OCI or reserves actually to the face of the profit and loss, which means it would affect things like reported earnings per share. So here's the rule then. On sale, the cumulative exchange differences previously recognised in OCI are recycled to the profit and loss. I've put down the journal there that would happen if those things happen to be gains. It would be the other way around, of course, if they happen to be losses. I'll just make up a little example, but I can put the numbers straight into a pro forma. If you were, for example, doing the profit on sale of a company and it was a foreign subsidiary, well, assume it's 100% subsidiary. I'm just making these numbers up. The good news is that you get the proceeds. I'm just going to make a number up, 100. The bad news is you've said goodbye to the subsidiary, bye-bye, so less the sub sold. And remember when we did disposals, you say goodbye to the net assets, goodbye. You say goodbye to the goodwill, goodbye. And you also say goodbye to the NCI, goodbye. So that would give you 65. Is that right? 75 less 10, 65. Yeah. So it looks like the profit on sale is going to be 100 minus 65. But in fact, you also have any recycled gains or losses. These are all of the exchange differences earlier recognised in OCI. Again, I'm going to make up a number and just say 20. So just check my maths. 100 minus 65 is 35 plus 20 is 55, isn't it? So that's the gain in the profit and loss. So the concept is called recycling. As I said, some academics get excited about it. You probably won't get excited in the exam, but it certainly might be tested. They would give you all the numbers, so there wouldn't really be any big calculation. It's just an extra line that you'd see when you sell a foreign subsidiary. That's all on that rule.